Okay, good afternoon, everybody, and welcome to Gary's Traders Group. This is your host, Gary Humeski. It is Monday, December the 8th, just a couple of weeks away from Christmas. Let's get right into it and get through the disclaimer. These webinars are for educational purposes only. I am not giving any kind of trading advice whatsoever. Okay. A lot of people will ask me, what is my thoughts between now and the end of the year? Well, after today, you think I'm bullish or bearish? Anybody want to take a guess? Oops. Guess it changed now. Bearish. Okay. That's one person. Two people say bearish. This is how I feel. Tom got it right. This is how I feel about what is coming. I think the holiday bull is going to be coming to town. And right now we experience today a couple of problems. The tech sector, number one. Secondly, McDonald's, Chevron, Exxon, and CAT, they all got hammered. And so that's why you saw the Dow being hit so hard. But all in all, between now and the end of the year, I do feel very, very bullish about the upcoming holidays. Now, there are some doomsayers out there, and they think this is what the next crisis is going to look like. Nasty. I'm not on that wagon at all. I think if I look at the PE of the entire market, which is really what you have to do because it's real easy to get segued into one direction or the other based on what you hear or, basically your sentiment of the day. You have to look at the macro picture and see what the big overall trend is. A great jobs report last week. We got claims coming out this week. And so all in all, I'm looking forward to the future as being extremely bright in the long run. And I believe that's what the direction that we're going to be heading. Okay. A little bit of fun I had there. Let's take a look at the macro picture. I've made some changes, folks. So I think this is, if somebody's interested in this, I'd be glad to show them how to do this. This gives a bigger overall picture, I think, rather than trying to use Fibonacci and learn how to snap and where do you snap from and what time frame do you use. And, it can become an art sometimes where as pivots and support and resistance are pretty much universal based on the time frame you're looking at. And what you see here, again, on the left is the Dow, in the middle is the S&P, and on the right is the NASDAQ. Using the same indicators we've always used, the Hull, the DPO on the bottom, the MOBO at top with the 4989 EMAs, as well as linear regression on a year chart, daily year chart. I simply threw in the pivot point and the various resistance levels so you guys can really see where the market could stretch to and where there's going to be potential hiccups in the road. And the overall trend, I think the market's going to continue to go up, but it'll be coupled with some pullbacks and consolidation and people looking to get good bargains. So as you see, the S&P came almost down and touched the pivot today and then bounced right back up. We're still on a downtrend from being way overbought. We're coming towards the mean on the bottom of price. You can see the exact same thing happen on the NASDAQ. It came down and touched the pivot and bounced back up. Now we do have a breakdown on both the S&P as well as the NASDAQ, but I think this is going to be temporary, folks. I said last Monday that I was bearish, and it pretty much proved out to be that case. Even though the overall market did go up, it was pretty volatile from day to day. Show of hands, how many people took any of the trades from last week? Anybody make any of the trades? There was some winners and some losers. What I try to do is I try to look at more of an overall picture and say, what if I spread my risk over a multitude of stocks, being also, both long and short, keeping, of course, cognizant of the overall trend. This is kind of what Pete does for his long-term calendars. He takes his money and spreads it out between 10 and 12 stocks. And this way he's working more of the law of averages and the probabilities in his favor. So from week to week, what I do is I take a snapshot of what I had looked at, how I interpreted it, and what if someone was to purchase each one of the trades on the closing price of the next day, Tuesday, because obviously you can't do anything today, and purchased a maximum of $1,000, however much $1,000 is going to buy, based on the expiration months and the strike prices I was putting. Here's where the numbers fell last week, which there was a total of 9 trades. If you would have invested $1,000, like I say, into each of those trades, it totaled, meaning under $1,000, it would have totaled $7,919. That's would have been your total outlay of cash. The profit, if you sold everything by that Friday, in other words, towards the end of the day, closing prices of Friday, and again, this would fluctuate a little bit up or down, but if you use the end-of-day prices on Friday, the profit would be $6,457. Your losses would be $2,005. Your net would be $4,452, which represents a 56% overall profit during that week. Here's what's interesting, folks, and this is a real important point to make about when do you take your money off the table using some good technical indicators and common sense, not to get greedy. Using the formulas that I've learned from Pete in Best Choice and Seasonality, coupled with the setup that you're looking at, not necessarily the overall macro picture, but the regular chart setups that I use in Thinkorswim, really becomes very, very accurate, upwards of 80% or more. So the interesting thing about last week that I wanted to bring to light is the actual win-loss ratio was 44%, which most people, if you ask, well, what's your win-loss ratio? And you said 44%, they turn their head and walk away. The key is the winners and losers. How much were the losers versus the winners? So it's evidence that you can still make great money trading directionally or with verticals and spreads, or perhaps some other option techniques, and still make a real good profit and a real good living. So I'm just trying to drive a point home that you don't have to have an 80% win-loss ratio and be right 8 out of 10 times. You can be right 4 out of 9 times and still make great money. Okay, that's the macro picture. Any questions? I still believe R1 resistance level on the S&P will be 2100 between now and the end of the year. I think that the S&P is still going to shoot for that. I'm looking for 18,135, thereabouts. Maybe we won't reach it by the end of the year on the Dow. I'm looking for 4885, thereabouts, as a resistance level on the NASDAQ. Okay, let's get to the weekly, what we got to look out for this week. Jobless claims on Thursday and retail sales on Thursday. I think retail sales is already going to be built into the market. I'm not too concerned about that. But jobless claims, it's going to be interesting to see what happened based on last week's job report. And then the producer price index that comes out on Friday morning. And the sentiment from the University of Michigan does have a little bit of impact on the market, but it's usually just a hiccup. The market reacts and then starts marching forward in whatever direction it intended to do for that day. I think the thing to also understand is now that we do have a Republican House, you can see how they flex their muscles. There's no vacation time. They're still at work. So that's kind of evidence of what we perhaps are going to see from the government moving forward. So be aware of these kind of things that could potentially affect your entrance or exit on any particular trade. on Thursday and Friday. Okay. With that said, I asked a question, did anybody take any of the trades from last week? I had a couple of people do post something. Somebody took DE, and they're up a nice chunk of change, $1,000, and UTX up 2,400, still in Goog. Anybody short FIVE? Was a great trade. One of our members made some good money on it. Worked out real good. Anybody take the Ulta earnings trade? Remember, I don't know if you remember, but if you recall last week, I was hesitant to short strength. I always am hesitant to short strength. Just like in the market right now, you know, even though the market hurt today, there was a pullback today because of, you know, like I say, McDonald's, Chevron, Exxon, Caterpillar, you know, they were the biggest losers on the Dow today. And then you had the tech sector pull back a little bit. Apple pulled back. But, you know, you've still got some great companies out there that are still pulling forward. In other words, they're not hit that bad. So anyways, that's good. That's good. People are making money. That's what I want to hear. And you're learning about how to analyze these things with these techniques as well as on your own. And I know other people use other things, which is great. You know, Bob is one of our members, and we've emailed each other back and forth for a couple of years now. You know, he's starting to get more diversified in his trading style and getting more comfortable with it and going on to more what some people would consider sophisticated options like condors or spreads and so forth. Another one of our members is, you know, doing ratios. So anyways, it's other people use other things to help confirm or give ideas, and I think that's great because the more knowledge you have, the better it is, as long as you don't do overkill. All right. One of the things that in regards to the bigger overall picture, like I was saying, and I think it's a trade that we all should perhaps take a look at. Oh, by the way, this is AutoZone, which is coming out with earnings tomorrow morning before market. We couldn't do anything about it, but I was looking at it. Don't like that candle, folks. Just don't like it. It's a nasty bearish engulfing candle. If we look more on a technical chart, this is a year, and you can see it's right at the top of linear regression. This is strictly from a technical standpoint. I'm not saying anything fundamental or what the analysts think. This is strictly technical. This is a very bearish signal right here at the top of linear regression, bearish engulfing with a John Persons pivot study trigger. You can see it maybe a little better if I remove the high-low bubble. There, you can see that. And you have a DPO and that was positive that if this thing at all goes lower tomorrow morning, it's going to break hard and go down. I didn't list it as a potential trade, obviously, because none of us could have taken advantage of it, but it's just going to be interesting to see what happens tomorrow morning. From a best choice standpoint, from a seasonality speaking, there really isn't much to say about it. Best profit per trade in the December area, it's, you know, more of a short than it is a long, but it's nothing I would really want to say, wow, let's run for it. What I do like is the January move. So you guys should write that down. AZO in January, AutoZone. Because if I look at that area and keep it on best profit per trade and say, hey, what does this area do? Boy, that's a nice winner. 10 out of 10 years, it runs straight up. That's using best profit per trade, best rating on whole zone. Will give you a shorter time frame, perhaps less profit. And there it is. It's not 5%, it's 3.86. So just keep AZO in mind, I think. And one of the things Pete told me is you don't have to take every trade. You don't want to force a trade. You don't want to say, because I want to be in the market and boy, this looks good and there's a lot of people going for it, man, I need to be in it. So always keep that in mind. But Bob, I'd be real interested how things turn out, so if you can email me tomorrow on the Condor on that, because that's something I normally would not do. And I know other people like to do it because you got to know how to unwind each leg if, in fact, it goes in one direction or the other. I mean, it's just two spreads that are put together. But really the way I was originally taught by Scott Macbeth, who writes the newsletter for Best Choice and was the options coordinator for Mother Merrill in Palm Springs for 8 years back in the 80s, when you still had to wear big, thick black glasses that are taped on the side. And, their computer took a whole floor. He had a track record of 22 months straight of doing condors every month. 22 months straight, folks. That's a pretty doggone good track record. That's how Pete met him, is he went to one of Scott's seminars to see how Scott was doing this. And one of the things Scott said is the condor setup to do condors, the best thing that could happen for the underlying security is it doesn't move much one way or the other. And that's how you can, keep the credit that you usually get of doing a condor. You don't want it to be violent in one direction or the other, unless, of course, you're going to unwind things very, very quick. But even then, things can come to bite you. So that's just one of the things I wanted to talk about. All right. One of the trades I think that we should all look at is trading the SPYs, because I am bullish on it. You can see, I don't know why, but you can see I'm not having up-to-date data for some reason, so let's add it in. Even though the SPYs are sitting way the heck up here, there may be a little bit of pullback like you saw, but overall, you still have a 90% probability from sometime perhaps towards the end of this week, middle of this week, early next week, in that area. That's why I'm talking about it today, is be prepared for it. Perhaps it's pulling back a little bit today on Best Choice. I mean, this is using the one standard deviation that I talked about last week. If we look at instead of 80% width on each side, a 90% width. Let's go to a shorter time frame so you guys can see this. It's interesting. Do you see where the 100% of retracement, meaning from here, the high, to here, low, is, this is for yearly retracement, is right at the pivot. This is 205.38, and this is 205.18. You can see how very, very close Fibonacci, and these are based on Woody pivots, by the way. One of my friends, Hank Fulton, who lives in Naples, was Woody's partner. And Hank is the one that actually created this. So I have to give him credit. And so that's what these are based on. And you can see how closely they emulate actually Fibonacci. So let's not get too messy here, and let's get rid of this so it looks a little bit cleaner. Perhaps there could be a retracement to the pivot, 205.18. It's at 206.61. But once that happens, look for a DPO pull-up. And then let's take a look at what kind of open interest we have and what we can expect. As you see, January is looking real rosy, especially right here at the 210 level. It's 175,000 open interest contracts. The vol is very low at 9.9%. Versus the spot front month of December at 9.48. Obviously do not recommend, or I'm not recommending anything, but I wouldn't suggest you trading the spot month. It's just time decay is going to eat up any kind of movement. So you see a lot of movement here. Now, if you look at what we're looking at from a seasonality standpoint, how much do we expect the SPYs to move after its retracement? Not a lot. 1.94%. That's on best rating of whole zone. Best profit per trade, let's see if it's more than the 1.94. 1.98. So let's stick to 1.94 as our potential move on the stock or on the index. So at a 206.61 times 1.1094, our expected move, it puts us at a target right there at 210, which is where all of this is. And you also have a 29 delta at the 210. So when I say, all right, how does that look from a charting standpoint? Boy, that's right there at the first resistance level, 210.31. So that, I think that's a pretty good looking trade. That we should all potentially be looking at. Now, you could stretch a little bit more if you wanted, again, depending on how strong this bounce becomes and we start running into the Christmas time. Only because if you look at the 212 level, there's 263,000 open interest contracts. Delta's almost 20, but it's doggone cheap, folks. 70 cents in a $206 stock. My gosh, that thing runs up to there. That thing is going to be worth, $3, $4. So take a look at that. All right, let's get to some earnings that are coming out this week. Do you want me to talk about the bearish or the bullish ones that I'm looking at? Somebody speak up. What do you guys want to see? More bullish trades or more bearish trades? Let's look at something middle of the road. How about that? I was looking through the earnings that are coming up, and Toll Brothers came out. Toll Brothers is coming out with their earnings this Wednesday, December the 10th, before market, and it has been verified. If you look at the charts on this, doesn't look pretty. Looks like it's going to pull down again, and you see the 49 is below the 89. But you also see the 49 really trying to pull up here, and it's almost an indecision. It's almost like the next day if it's a doji. Boy, that's very common. And do you see how this just looks like it's trading within a range? Very common before earnings. What does seasonality tell us? That's from the beginning or the end of November. I wouldn't use that. That's just snapping it based on best rating. I would use best profit and highlight the area. Now I got an 80% probability on best profit with about a 4.62% move. Here's what's interesting. And I wanted to share all of this for you to say, look, from a seasonality standpoint, you got more odds. Not a great looking trade from a rating factor, right? I could use best rating of coordinates. It's probably going to give about the same. Well, a little bit less, 2.83. But it starts sometime this week, like after earnings. And another technique to use if you don't want to go through the arduous process of looking at each year through Thinkorswim's charting program to see what that particular security did during that third quarter earnings, to see if did it actually pop, you can do this as well. You can see that was a big move. You can see that it pulled down and then pulled up. Popped up and then pulled down. But ultimately, you see if you're buying into January, you're going to deal with the ups and downs, and it's still going to move up from when perhaps you had bought it. Okay? So that's another technique you can use using best choice. That's where we're at right now in 2014, kind of in the middle here. So you got about 80% there. Technically speaking, charts don't look that great. But this is what struck me, folks, is strictly what I call an OI play, or what I call open interest. Anybody tell me by looking at the bullish side, which strike price do you think jumped out at me? Somebody type in the 2-digit number. Yeah, right here. 42,704 open interest contracts at the money at 34 for January. And I don't see that kind of short interest. I see short interest, but nothing compared to the long interest. You also look at spot month long interest versus short interest. So from an OI standpoint, there's a lot of people spending a lot of money on a bullish trade for Toll Brothers in the building sector. One of the things you can also do is look at the spiders and say, well, what are the spiders for the building sector show us? And that's XHB. That's kind of the home builders, right? And so you can see from December right into February, using best profit per trade. Not really great, right? 75%. I mean, in other words, there's a greater probability of it going up than it is obviously going down, and that's one of the things that you obviously want to be able to see. But you also see that this is already 2014, so it's taken a real big run up. So when you see something like that and you're saying, well, where could this thing stretch to, right? I don't know if you guys ever use this from Best Choice. It gives you a cross here so you can look back into time to be able to see, is that a potential resistance or support level? For example, if you do it on here, look back into time, and do you see any? And I think you guys can see right there in July, it peaked. And where that used to be a resistance now becomes a support. And that's one of the techniques to use. So yes, Abraham, you're absolutely right. So from an overall perspective, you have a probability of things going up. And then so you look at an individual situation, you got 42,000. So I think that's interesting. Now, throw some curveballs at you. Since this is not a very expensive stock, right? I started experimenting with something that I'm sure you've heard of, and it's called a straddle. In other words, straddle says, I don't know which side it's going to go, so I'm going to buy both sides right at the money at 34. That's not too expensive from a cash standpoint to be on both sides of the coin, right? I think that's what I did, yeah, on the straddle, 233. Why did I do the 35s? For some reason, I was looking at the 30. Oh, yeah, I'm sorry, the 35s. I saw more open interest on it. And it's less expensive. So there's a thought. The other is if you say, okay, I'm going to, instead of buy a call and buy a put at the exact same strike level, I'm going to buy a call one strike out of the money, and I'm going to buy a put one strike below the money. That's called a strangle. And that also is not that expensive if you do the 35.34. As a matter of fact, it's even less expensive. It's only $1.80. Well, compare $1.80, right? That's only, look, we're at $34.60, so we're only 40 cents off from being at the money for January 35s, right? We're a little bit further away on January 34s. We're $1.60 away. But if it does miss earnings and tanks, all you do is unwind and just drop whichever leg is not going in that direction and let the other leg run. Very, very simple. That's a great question, Jose. Where does it have to move in order to be profitable? Here's an important thing and I want you guys to start using this technique because it really does work. Do you see over here on the right, I should maybe change that coloring because it's very light in color. There's a plus or minus $1.69 on the Decembers. There's a plus or minus $2.47 with a 27.11% probability. If you go through analysis, let's type this in, TOL. Well, we got to first do the sim trade on it. Okay, there's our sim trade, $34.35, $1.80. Let's lock it. Now let's go to the risk profile. Right, that is where we're currently at. And so to break, well, here's another way, folks, that you can do it without having to go through all of this. And I didn't want to spend a lot of time on that. And you could do this on paper just so you know. Buy that and simply click confirm and send. It will tell you where each stock has to move to break even. Jose, 32.20 on the short side, 36.80 on the long side. Profit is infinite. Your max loss is what you put up, which is $180 per contract. So I just thought that was an interesting potential play. Now, if you want to just do, the directional, if you were just saying, hey, I think this thing may hop, I would look at doing the 34s simply of an OI play, strictly an OI play. That's it. Because from seasonality, it's okay. Home builders going up, it's okay. I would put that at using those two tools at probably a 7 out of 10. But from an OI standpoint, that definitely brings up that 7. Okay, that's toll. MW is something I'm thinking of shorting, but I want to also just share with you what these thoughts are with this, because from a seasonality standpoint, there's a 70% probability. Again, not that great. Right? Well, someplace I think I had maybe a best profit per trade. I had found a 80%. Maybe it's this. There it is. 80% possibility to short. The one thing I do see is this is in a major downward trend. You got a crossed MAC. If you go to my charting, you can see it's the 49 crossed the 89 back here in September. Continues to be low. See how the price moves up, hits it, comes back down. It's the 89, comes back down. There's that leashing effect where it pulls away from the leash, you pull it back. Pulls away, pulls back, pulls away. So earnings are the 10th aftermarket, which is again Wednesday, this upcoming Wednesday. Seasonally, an okay, like I say, nothing great, 80% probability. But I do see some interesting things. Today, the 40, when I was monitoring this strike level on the short side in spot month, the ask was 75 cents. Somebody came in, because this is an even number that has not changed. Somebody came in and bought 4,000 contracts at 75 cents or $75. Can anybody tell me how much somebody dropped in one full swoop to take that position? It's pretty easy math if you got a calculator. $75 times 4,000 contracts. Somebody came in and spent $300,000 to take that position. So you think they may know something? Now look at OI on this side, on the long side. Now look at the OI on the short. Besides being one strikeout, there's over 3,000 contracts at the money, 1,700. But that's what really jumped out at me, is somebody came in and dropped $300,000 for the December 40. And that puts me right at S3, support level 3, $40.64. Now, if I took Fibonacci extension on a 6-month basis, took it from the high to the low, oops, let's try that again, the high to the low to the high, that's at 50% retracement as well, or 50% extension of its current movement pattern over the last 6 months. 61.8, which is the more prevalent one where stocks will tend to hesitate. And a lot of people use that as profit targets, is below 40. So thought that was pretty interesting. I wanted to share that with you guys. So that was... Now, one of the things that threw me for a loop, though, is what do the analysts think? Not that I really count on these guys, but they're really bullish on this. 5 out of 5 are very strong buy. Now, I don't know if that's over the longer term. Remember, Joseph A. Banks bought Men's Warehouse, and they were doing a lot of heavy Christmas advertising. So I don't know if this has any kind of play to do with the last 3 months worth of their sales, but it kind of threw me for a little bit of loop. So be aware of that. Now, one of the ones we made money on, which I had done the research on, and I remember I joined Costco and went and investigated them on a Saturday, and I couldn't find a parking spot, went in there, and it was just packed full of people with these huge shopping carts filled to the brim and waiting in lines. The majority of the people were in 50s and 60s and even 70s. Some people in their 40s, very few in their 30s, nobody in their 20s, but the demographics is the baby boomers that they cater to, and they're the ones that control the most wealth in the country. But I also know something about trees. I love trees. I've been to the redwood forest, stood in front and the bottom base of a huge redwood. If you've never done something like that, put it on your bucket list, because it's well worth doing. It humbles you. It really does. Shows you the power of nature. So trees do not grow to the sky, even though they can be very tall and powerful. And boy, Costco has just had one heck of a run since their last earnings, right? Just right on up. And you can see it's kind of consolidating. They have earnings coming out Wednesday, verified before market. So when I look at this charting from a year standpoint, not on 6 months, but 1 year, take a macro picture, they are also screaming at the top of a 1-year linear regression, and they just hit a 1-year high. So if I used a fib retracement from a 1 year, come on, there it is. We see between the 38 and the 50 is between 130 and 126. Right smack in the middle is your second resistance level at 128.92. I'm sorry, third support level, not resistance, third support level, where the second support level is right there at 130, 131. So in that area is where there's going to be resistance if it happens to pull back. And remember, there's that leashing effect. It pulls away, comes back to that 49. It's pulled way away. That dog is strayed way out there. It's been sniffing in the bushes. It sees something nice. And boy, you're walking on the path, and it's time to pull the dog back. Sorry, I use that analogy because I walk my Danes all the time. So if you look at the Costco open interest and volume, there seems to be a prevalence of interest on the front month at the 141 level. And for $1.43, folks, that's 1% of the stock price. It's pretty doggone inexpensive. From a seasonality standpoint, it's a 90% short. From about, well, last Thursday, let's say. Again, these are averages, give or take a week. So historically in this time frame, she does go down. You know, look at various years, what happened. Last year, it tanked hard after it pulled up hard from a good earnings. So wanted to throw that one out there for you guys to consider and look at. One that I don't know about, write this one down as well. You also get it in the Excel sheet. It's not this week, but it's next week. So, and it's a great company, Red Hat. And they do have earnings that are coming out, I believe, on the 18th. It's only a 70%er, but I believe the company is a strong company, and it's had a good progression up. It's pulling back, and I hope it pulls way down here to linear, down to the bottom of linear regression. On best choice, it probably won't be that close. Here you can see that it's, let's do 6 months. Boy, it just bounced right off that 49, or hit the 49. It hasn't bounced yet, but it hit the 49. So it may bust through that, like sometimes stocks will do. They'll run up and bust through one of the EMAs, but then linger at the other. As you can see, that's what happened here, and then it continued to strike down until it was finally it was oversold, and then it ran up. And it's had a nice run, folks, from about $52, $53 all the way to $63. That's a $10 move. A $10 move on a $50+ stock is over a 20% move. So it's natural some profit taking is going to be taken. So as I say, it's a 70%er on best choice. 8.07% within this time frame, 12/12 to 12/24. So it's right when earnings are coming out. which is on the 18th. That's unconfirmed, so make sure you come back to it, but pretty much that doesn't change. And that's after market. This is what jumped out at me, folks. Look at all this bullish interest. 14,000 plus contracts, and that's cheap. Almost, because it pulled on $1.62, and I analyzed this yesterday, the delta was above 20. So that doesn't concern me at 0.19. That's inexpensive, folks. It's less than 1% at 55 cents at the 65s. So does it have that potential? Well, with an 8.07% average move during that time, if I would just use today's closing price of 60.06 times 1.0807. Boy, pretty doggone close, huh? $64.90. So if this thing bounces up and the market pulls up tomorrow, which very likely it's going to after such a strong pullback today, you may see some great buying opportunities, especially when they got the tech sector that got beat down and all the people that love Apple, they see an opportunity to buy more because that company is only going to continue to grow. And this is the kind of stuff you'll see happen during 2015 as well. But $64.90, you could go a little bit closer to the money at $62.50 with a 33 delta, which is, what did I put? D's 62.5 is what I wrote down to be more conservative. I'm sorry, January 62.5 to be more conservative. So that's a decent one to look at. What else do I have? Adobe. Great company. Thursday, after market, on the 11th of December. They have earnings coming out. Adobe, from a seasonal perspective, not that great, folks. 76.62 or 92. Hold on, let me see this. I think this is going to change a little bit. Yeah, there it is, 90%. Anyway, I had it written down someplace. 90% perspective or potential probability. Not a real big move, folks. 3.46 is the what you're expecting on an average move. $72.05 times our average move of 1.0346. 346 gives us a target of $74.54, which means you could probably be looking at the 75s in January. You see there's some good open interest here stretching to the 77.5s. Since this is spot month, now the one thing I caution you is the volatility here is, I'm sorry, not the vol. Where's the vol? There's a, at the money is 40 here where it's 29 here. So you got to always remember that is being, these prices are being inflated because of the unknown. When you go out an extra month, you don't have that same hit. And so you've got a lot of strength here at the money at $4. So you could do a vertical if you want to mitigate your expense for $2.43. One of the things, folks, that I always do this on any spread that I do. I will not make the spread until I have an at least 2-to-1 return. Minimum. Got to have at least a 2-to-1 return. Since this is a $5 spread that I'm doing, between $70 and $75, my cost basis to get in is $2.43. That still leaves me at $2.57 potential return, which is a 2-to-1 for me. So always remember that. That's very important. Which one, Bob, do you get a 90% long on? The Adobe? Is that the one that we were just talking about? This one here? There's a 90% long. Prior one using best. Prior stock that we were looking at? Forgot which one was it. Red Hat? Was that the last one we were looking at, is Red Hat? I think it was. Yeah, RHT. Well, one of the things everybody needs to start doing, whenever you look at a seasonality chart, you're going to type in the symbol. You're always going to go to the puzzle piece and click it, and then wait for the download, and then snap the area. See, I'm getting a 70% using best rating of whole zone. Now that's just by quickly snapping it. If I snap a little bit further away, it still gives me a 70. So now I have to use best profit and snap that same area. Yeah, see, I'm still getting a 70. So I don't even get a 90 anymore. But believe it or not, that 70 is a bigger percent potential move than what I used. I used 3.46 or 47. So always remember to download, because that'll change it to 10 years worth of history. Sometimes if you are looking at stocks that'll have 12 years worth of history. Some people say, well, I'd rather have 12 years. Not necessarily. Like, we really don't care what Apple did 12 years ago. For that matter, even 10 years ago. We care what Apple's really done over the last 4 or 5 years. So, I mean, there's a 10% potential move at that same time frame using best profit per se. So I used a 3.46, guys. Everything I just snapped, even though the win-loss percentage is lower, but the potential profit move is greater. And when we were looking at Red Hat, we're not looking at a 10% move, which would put it at 66. And we're looking at, a $2.50 move here at the 62.5, which is again about 2.3% premium. Or do the vertical. One of the stocks, one of the things I do is I have my Gary 11 that I always look at, and I haven't been trading those lately because it's coming to the end of the year. I call it my weekly main stock list. These are 11 stocks, great stocks, almost primarily all in the NASDAQ, that are just great volatile stocks that have moves that you can play pretty much regularly, week in, week out. Just, waiting for the breakout, waiting for the right setup. And hey, it's great if you have seasonal confirmation on top of that. I normally would not. I just use a breakout method and trade the weeklies on it, because you can get such bang for the buck doing strictly bull call spreads or bear put spreads. Strictly spread trading, in other words. So one of the things I was looking at is Baidu in this area. I had an 8 out of 9 year move upwards. And I thought, wow. And then I looked at the consistency and percentage move over the last 1, 2, 3, 4, 5, 6 years. So I like that. So 386 move, where's it sitting at now? Well, it got beat down. Boy, that doesn't look right, does it? There, that looks better. Upward trend, oversold on one standard deviation. I have a historical probability of a 3.86% move. If I look at any kind of volume out there and open interest, I saw that right there, 4,723 contracts being bought today on a bullish side with 8,122 open interest, 32 delta, $4.80 on a 227 stock. That is less than 2%. It's expensive cash-wise, right? So since these are $10 increments, if you did the 230 by the 240, $3.70, folks, for a $10 spread. Remember, on a spread, I'm always looking to at least do a 2-to-1 minimum. This is a lot more than 2-to-1. My break even is 233.70. This thing pops up to over 240, which based on a 3.86% average move, 227.67 times 1.0386. Boy, it's real close, 236, right? All I'm risking is that 370 with a potential of 630. You could even try more conservative, do at the money, but see, that's not a 2-to-1 return for me. So I look at charting on Baidu. Bounced right off of my extension of 227.90, 227.67. The first support level is 232.51. That's right exactly at the 23% retracement between its low and its high. And it's getting towards the bottom of linear regression. It's becoming oversold. Guys, if this week continues to be a little bit more bearish or up and down, all of these stocks you need to be looking at and take and play the bounce. Play the bounce off of them. That's what I'm looking to do with Baidu. Some other stocks to keep in mind, I think that Goldman Sachs, GS, is something I'm going to be looking at to trade here soon. You can see what it's done. It's really taking a strong run. I believe that it's going to hit 200 target price. Pick that up for 335 in January. Or do a bull call since you, that's another thing, by the way, on any spread, whatever strike I'm buying, I want to have some intrinsic value already built in. It's a $5 spread between 195 and 200. It's $5 difference. But currently the stock is at what, 96.62. So I have $1.62 of intrinsic value already built in. And with a market that went down, a stock that goes up means it's got a lot of strength. Now it's a little bit pricey at 260. It's not a 2-to-1 return for me. So maybe it'll pull back a little bit tomorrow. That's one way to look at it. GoPro, I'm still, a lot of people, GPRO is another stock I'm looking at. Still pretty bullish about it. Hit the first support level of $67.65. Close just, it is right there at that first support level. Doesn't look like it's going to pull up anytime soon. I think it's still going to pull down a little bit, but looking for a bounce around the $60.13 level. At that point, I would be looking to play it long. Hopefully, if it gets down to that $60 and change level, we're going to be looking for the 67 as a potential strike level for it to come back to. And I could probably pick that up for pretty cheap. You can see the 70 right now. There's 8,700 contracts. Another stock, there's two more stocks that I'm strong on, CMG and Starbucks. I like both of those for longer term. I don't know about Yum. Yum Brands is something I'm questioning that I may want to, if you're in it, you may want to consider getting out of it. Let's see. I'm sorry I didn't hit that like I shared with you you're supposed to do. There's an 80% short coming into January, and it is sitting at up here right now. So what do we have? 50-50. I just think it's overbought right now, and it's going to pull back. Same thing with Panera Bread, I think, is a possibility for it to pull back. I think a couple of pharmaceuticals that are good buys are Celgene, CELG. This is for longer term, folks. This isn't a shorter term play. But I believe Celgene, I listened to the CEO come online at CNBC, talk about his product lines and some of the things that they've got. Some new drugs that they've come out with that are just going to be phenomenal for a lot of different major trauma diseases. So I think they're going to continue on a rip-roar pattern. And from a seasonality standpoint, it's not something super great, but there is a pretty strong probability. Now, if I said, well, how does it look from now to the end of the year? You still got that same 70% probability just from a seasonal standpoint, let alone from a fundamental. Another one is Amgen, AMGN, that I'm positive about. I think that stock has got a lot of drugs in its pipeline that are very, very strong, and it's also going to continue a nice trek upwards. Last is Biogen. I think it's BIGN. Is that what it is? No. Anybody know the Biogen ticker? Oh, yeah, BIB. That's right. Boy, talk about nice volatility. Jeez, oh, Pete's. Love that. Again, another 70% probability. Thanks, Leon. Okay, I am done for now. I'm going to do one more session, folks, next week, and then I'm shutting down for the rest of the year. So, and next week's will probably be not a lot about trading things for that coming week, because then we're running right into the Christmas. We may talk about some other things like probability analysis, in the money, out of the money. What do you want as settings? I think, Bob, you brought that up. Maybe I'll bring that up, talk about that just real quick. Whenever you're looking at a probability analysis chart, you want the settings. Don't change the probability range of one standard deviation. Keep the settings at in the money, only because if that probability is higher than the rest of the probabilities of closing above or at, that if it doesn't stretch to that range, then you still have the probability of making money, no pun intended. I hope that answers that. Okay, any stocks you want me to look at real quick? Yes, no? All right, folks, if not, I wish you guys a great trading week, and we will talk to everybody next week. Good trading, everybody.